I haven't seen this many potential breakout plays in a very long time. Of course, I will dive into some of them for you, but right now we are just a few points away from all-time high as the S&P 500, or SPY I should say, is about $3.50 away from 600. And then I had to double check what Tom Lee said here. Tom Lee said that there is a ton of money on the sidelines still. And more importantly, there is a high amount of shorts.
I think the feedback we get from a lot of folks is they think stocks shouldn't be rising. So I would say, given the amount of cash on the sidelines, the fact that short interest is going up, and we have a quiet week and markets are rallying, I think the risk is now of a substantial leg up rally from here.
So according to Grok, short interest in the US stock market is elevated as of June 2025. As a matter of fact, it has reached approximately 2.3% for all S&P 500 stocks. Now, that doesn't sound like a lot, but remember, we're talking about the entirety of the S&P 500, not just one individual stock. This is the highest level in 7 years, making a 35% increase year to date. Hedge fund short positions on NASDAQ stocks have also risen significantly, with shorts as a share of total open interest hitting 41%. The highest since February of 2021. So if you guys remember in 2021, right after the pandemic, when we had this V-shaped correction, a lot of people, a lot of hedge fund managers, a lot of these people on CNBC, in February 2021 or beginning of 2021, they couldn't really believe that this hype was real. And that we were going to get some sort of double dip correction. The market ended up rallying another 25% before starting a bear market in January 2022. And I think we could be in a very similar type of situation here. So I will share some trade setups with you towards the end, but let's dive into the news and the analysis real quick because you need to know this. If we take a look at the Magnificent Seven trailing PE, this is the price earnings ratio of the Magnificent Seven right now, so not the forward PE. You can see that the total valuation right now is at 42x. Now, obviously that is a high valuation. But compared to most of the bubbles in history, and I'm not going to go through all of these, the one that I really care about the most is the dot-com bubble, because I've said this before, but I think that what we are seeing now with the breadth thrust indicators that I've shared with you over the last month or so, that we are mimicking a situation that I saw in the dot-com era, where we've had 3 years of 20+% gains. Now, initially, yes, I didn't think that it was likely we would get a third year of 20+% gains. But in the dot-com era, the valuation was 65 and bond yields were going up. And also they were raising rates. The policy rate was going up. Right now, bond yields are going up and the policy rate is flat, meaning the Fed has paused or skipped a few times in a row now since the initial cut in September. I'm under no illusion. There is no doubt that valuations are high right now. I've shared this with you several times. But if you look here, the S&P 500 is in the 95th percentile of valuations. NASDAQ is very close. Russell 2000, more on that later because I took a trade on this based on the video that I shared with you last week. Valuations are high. Nobody's saying they're not. But obviously, this is a stock market news channel and an analysis channel. And we talk about long term as well as short term. And in the short term, I keep saying that unless we see any sort of news of the tariff policy being negative on the ground, such as limited supply, empty shelves, etc., which seem now very far from reality as the Trump administration continues to flip-flop on tariffs. In the short term, I think it's plausible that we see a rally, and based on all of the breadth indicators that I shared with you, that we will likely get a double-digit year, whether it's 20% or 10%. I'm obviously I like to stick to modesty in this regard, and I told you guys that almost 650 on the SPY means that year to date for 2025 would be a 10% gain. But I do think that the valuations, the high yields, the government debt, more spending, more tax cuts, I think that is going to contribute to a potential recession down the road. I just think that that kind of injection of liquidity will kick the can down the road and can lead us to even higher valuations. And we are seeing something now that reminds me more of the dot-com era. Is if you look here, it says AI boom delivers a record contribution for U.S. economy. Computer equipment outlays added 1% to the first quarter GDP, meaning that this is the largest contribution ever of computer outlays to GDP. And this is only rivaled by what we saw in the dot-com era. Now, historically, when this hits a peak, we are very close to that bust cycle as well. This is a boom and bust cycle. I'm not saying that the AI boom or AI industry is anything like dot-com. I remember the dot-com boom. The dot-com boom was really based on hype, whereas the AI boom is actually flush with use cases, with profitable companies, with trillion-dollar companies, with companies that are still growing like Nvidia at 70% revenue. It's driven by companies that are generating more cash than most countries. So I'm not saying it's the same, but obviously initially when we have this sort of paradigm shift and this new industry or this over focus in a new industry like AI, there tends to be a lot of money driven there. And at some point, that money gets cut off, and now companies and hyperscalers, they have to use or try to come up with use cases for all the money that they spend on Nvidia chips, on racks, on software, etc. And there is a natural slowdown before it kicks back into gear. Right now, we are in the apex of it. And speaking of GDP, the Federal Bank of Atlanta just came out with their GDP estimate for Q2. Remember, Q1 was negative. They forecasted as negative, and it actually came out negative. Q2, they're forecasting it at 4.6%. This obviously flies in the face of every expectation. Even on this channel, I said that if the tariffs were to go through as advertised with that chart that seems like ages ago now, where every country gets 100% tariff, that yes, that would likely have effects on GDP. But obviously those tariffs have been dialed back, and that 90-day pause will take us into the end or close to the end of Q2 and will not even affect GDP for Q2. And I don't think it was a surprise to anybody that Q2 earnings were actually really good. We also got the first wave of employment numbers with JOLTS job openings coming in higher than expected. So more job openings than expected. And we have the unemployment rate this Friday. So we will see if we come in at 4.2%. So far, unemployment rate has been steady. That has not shown any cracks. Now, the 10-year yield has been steady for about 3 weeks now, which is more than we can ask. And it hasn't really moved up. And I think it has a lot to do with the fact that Besant took over China policy and that we saw a lot of pauses, reprieves, really a dialing back of the rhetoric with regards to high tariffs. The 20-year also hit that 5% and is now dialing back. And if we look at the 30-year, it is a very similar story. Hit that 5% and is now dialing back. There may actually be an opportunity, a contrarian opportunity in long bonds such as TLT and TMF. I don't know about that yet. I'm going to have to check on the charts. And if we take a look at high yield spreads, this is an estimation or an indication of what the market thinks about the economy or the health of the economy. These are below investment grade corporate bonds compared to US Treasuries, which are considered the safest. The lower this goes, the more confidence there is ostensibly in the economy and in earnings and in corporate earnings, etc. And you can see here that this is really not spelling danger. We did see a peak right around the time of tariffs. We hit almost 4 on this index, the high yield index, and we are now back in the low 3s. Again, this is something very similar to what we saw during the dot-com era, and this can lead to more of a stock rally or more of a melt up in the short term, as fears about the economy, and more specifically in this case, tariffs, are dialed back. Now, someone who isn't happy about the government debt and about the government issuing more debt through this big, beautiful bill is Elon Musk. Now, I have to hand it to him, credit where credit is due. I did not think that he would be principled enough to go against the Trump administration, being that he worked so hard to not only help the Trump administration win, but he gave a lot of his own money and more importantly, a lot of his own time away from Tesla, away from SpaceX. But he tweeted today and said, "I'm sorry, but I just can't stand it anymore. The massive, outrageous, pork-filled congressional spending bill is a disgusting abomination. Shame on those who voted for it. You know you did wrong. You know it." I personally happen to agree with him, but it's not about what I think. It's about what's going to happen. but I definitely agree with him on that sentiment. Now, in the last video, I did go over a few key plays and charts for you, and I said AMD looks like it might be breaking out. Now, we had this downtrend line that you can see here, and we bounced off of that weekly gap. If I switch to the weekly chart, you can see that gap there. I would have much rather had a liquidity sweep here before going up, but you could see that we broke out of that, and there is that price level that I was eyeing. If you go all the way back to 2022, there is that major price level that was support, resistance, resistance, and we are now breaking above it again, and we closed above that 117 mark, which in my view is pivotal for a potential rally on AMD. Now, I got a couple of comments from you guys saying, why do you believe in AMD? It's not that I believe in AMD. I personally am invested heavy in NVIDIA and SOXL. I don't need more semiconductor exposure. In my opinion, my portfolio already has a ton of semiconductor exposure, but there is a big difference between trading and investing. So I'm not buying AMD for the long term, and I have no problem with your thesis if you think it's a good company for you, your portfolio, your goals, and how you view the markets. I don't argue with anybody. If your thesis is sound and you have a solid thesis and you're not just buying ticker symbols randomly, I really have no quarrel with you. I'm not the end all be all when it comes to stocks. I am going to be wrong. Everyone's going to be wrong. I hope to be right more times than I'm wrong. And thankfully, I have been, especially this year. So for me, I'm talking about AMD in this case as a trade, and I will trade anything. I'll trade toilet paper. It doesn't matter. If I can exploit an opportunity, I'm going to trade it. Now, I do find it curious that I have not seen anything bullish in the options activity. Not that there needs to be, but I thought we would get way more orders on AMD at this stage here. In the same way that we got on the Russell 2000, a very similar breakout scenario here. If I pull up the 21 EMA, you could see how many times it's danced around the 21 EMA, finally pushed up above this trend line. Now, we still do have resistance here, even though I already entered a position, and I do have a tight stop because of this resistance, but I have seen IWM continue to gap up when it is ready to go. And being that small caps have really lagged behind the S&P 500 and the NASDAQ in this recovery, small caps, and more specifically the Russell 2000, tends to disproportionately benefit from money printing, from deregulation, and from a spending bill. So I did front run this, even though we also have an inverse head and shoulders, as you see here. And I did kind of front run this, but we also saw massive call buying. So we saw a $17.6 million order, mostly at the ask of these 215 calls expiring June 30th. I did not go that, I didn't go that short of a distance. I went more with the August calls here. And we also saw $4 million come in of the 208 calls expiring August 15th. And yesterday we saw another $3 million order of the 215 calls expiring August 15th. Most of those options were at the ask, indicating that these are buys and not sells. Also very important that the volume surpasses the open interest, meaning that they're not closes, they are new options. That's part of the reason why I also front ran this, because the strength of the options orders that we saw. Now I have a tight stop on IWM, so I'm not tripping too bad about it. And then if you look at SOXL, remember that Broadcom earnings are on Thursday as of the time of this recording. Broadcom is the biggest holding in SOXL. Second biggest holding is NVIDIA, and AMD is the fourth biggest holding. And look how much runway we have if those semiconductor companies like AMD, as well as Texas Instruments, if NVIDIA gets back to all-time highs, there is quite a bit of runway on SOXL. In full disclosure, we did pick this up at $7, currently trading at $18, and I think that there's even more opportunity here. Again, sweeping that gap, not entirely, but bouncing off of the 21 EMA here and now breaking out of this, if you want to call it a bull flag or a trend line, I don't care what you call it, but you see this breakout here. If you did want to trade Broadcom earnings, you are much better trading SOXL, as Broadcom will have IV crush, and you can indirectly trade Broadcom by trading SOXL and not getting hit so hard with that IV crush, especially if you're wrong. And speaking of wrong, I'm still holding my Uber calls here. I did have calls on Uber that are currently down, and I did roll them into July because I was playing a break and retest of this level on Uber. And we did get a break and a retest, and we were up on this position, but we decided to, or Uber decided to drop to this level, which is a weekly gap. Now, the reason that we dropped to this level, in my opinion, is because of the enthusiasm surrounding Tesla and robotaxi. So we're seeing this kind of inverse sentiment where Tesla is obviously bullish going into robotaxi, and Uber is seen as the main competitor to Tesla, as well as Google, which has Waymo. So I'm still holding these, and they are down, but I'm still holding them because we are at this next support resistance level. This was the high from February. But obviously, if we close below this, then I will have to close those for a loss. I did take a lotto on MicroStrategy because I saw in the options volume, there was something super ridiculous. We were seeing a massive amount of volume compared to open interest last week. So and it was for a short dated expiry. So June 6th, we had 23,000 versus 900 open interest of the 385 calls, the 382.5 calls, the 380 calls, all expiring June 6th. It was just a few days. So I ended up jumping into those because to me, it looked like something insider. It looked like an insider play. And I said, could this be S&P 500 inclusion? But I know that MicroStrategy doesn't meet the profit requirements for the S&P 500. So I said they're not profitable enough. I have no clue. And what it ended up being was that MicroStrategy announced just today, as of the time of this recording, an IPO of its 10% Series A perpetual Stride preferred stock today. This was definitely an insider. This was definitely corruption, but at least we have the tools in order to monitor it. I ended up managing my risk because even on the chart, there wasn't a prime setup. You could see here with this pump, it's not like we bounced off of a support level or anything. It looked like we were dropping from these equal highs here. And we weren't dropping to a support level. We didn't even get to a level that makes sense. We just rallied based on that announcement. IV kicked into overdrive and those calls went up 170%. I ended up closing those out, obviously because they expired June 6th, which was just in a few days. Anyway, traders, like I said, I haven't seen this many potential breakouts here. Times like this are kind of a gift and a curse for those of us who also participate in short-term trades because there are so many setups and you want to be, and they're all, in this case, they're all bullish. So you want to take each and every one of them, right? But you forget that most of these big stocks are also correlated to the general market. And if the general market sees a pullback, then there goes all of your positions. So you can't possibly take every single one and still manage risk soundly because essentially a rising tide lifts all boats and they're all part of the same mechanism. Yes, you can get an off day where Tesla rallies 6%, but the S&P 500 is down. But in general, you do not want to go against the market sentiment, or you don't want to load in heavy in too many ticker symbols because you're essentially taking the same position across the board, even if it's in multiple tickers. So I'm going to have to be careful to manage my risk appropriately. But if you want to sign up and trade live with me every day, I day trade futures and sometimes day trade options. Every single day, I swing trade options, and then obviously we do long-term analysis as well as long-term buys. We will also be doing our monthly investing call this weekend where I go over with the group what I'm looking at from a long-term perspective, what entry points I'm looking at, etc. So whether you're interested in trading or whether you're interested in investing only, there are a couple of tiers. Join which one is appropriate for you. Leave a comment down below. Let me know what you think. Do you think that there is something that is on your radar that you think is worth looking at in terms of a breakout? Would love to know what you are bullish on or bearish on even. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.